All right, so you've got your financial house in order. Today we're taking that solid foundation and diving into the world of investing. We're going to talk about how to turn your savings into a real wealth-generating engine. Okay, so here's what we've got on tap. First, we'll cover the one rule you have to know about investing. Then we'll map out your main options. After that, we'll look at a huge decision every investor has to make. Figure out how you can craft your own personal strategy, and wrap it all up by talking about the ultimate goal, building a money machine for financial freedom.
All right, so you've done the hard work, you've gotten rid of that nasty high-interest debt, you've got your emergency fund ready to go, so what now? What's the next step to really make your money work for you?
Well, the answer is, of course, investing. But hold on. Before you dive in headfirst, there is one fundamental principle, you could almost call it a law of financial physics, that you absolutely positively have to get. This one idea is going to guide every single investment decision you make from here on out.
And here it is, the big one. High risk, high return. It's the fundamental trade-off of this entire game. You want a shot at bigger profits, you've got to be okay with taking on bigger risks. It's that simple. On the flip side, if you want your money to be super safe, you have to accept that your returns are probably going to be pretty modest. Every single thing we talk about today fits somewhere along this line.
Okay, so with that risk-return compass in hand, let's start exploring the landscape. What are the main places you can actually put your money?
You know, when you boil it all down, you've really got three main buckets. You've got your savings accounts, you've got real estate, physical property, and then you have the stock market. Let's kick things off with the safest one, the one that kind of sets the baseline for everything else.
Right now, if you find a good high-yield savings account, you can probably get somewhere between 4 and 6% a year. But listen, that number is so important. It's not just a return, it's your benchmark. It's basically what you can get for taking almost zero risk. So any other investment, I don't care if it's buying a building or a share of a company, it had better offer a higher potential return. Otherwise, why would you even bother with the extra risk and headache?
Okay, let's talk real estate. I mean, the appeal here is pretty obvious, right? You get to own a real, physical thing, a tangible asset, and it can have awesome long-term growth potential. But, and it's a big but, it's not easy. It can be really hard to find good, transparent data, and you usually need a ton of money just to get started. It's definitely a more hands-on, complex way to invest.
And that brings us to the stock market. Now, when you get here, you're standing at a fork in the road, and you have a really important choice to make. You have to decide what kind of player you want to be in this game. Are you an investor or are you a trader?
And believe me, this distinction is everything. A trader is all about the short term. They're watching charts, trying to profit from little price jumps and dips. An investor? That's a totally different mindset. You're buying a small piece of an actual business, a company you believe in for the long haul. You're trying to build wealth over years, not minutes. And just so we're clear, for the rest of this conversation, we are 100% focused on being an investor.
So if you want to pick your own stocks, this is one way to do it. We'll call it the analyst path. It's like you're becoming a financial detective. You're digging into the company's books, sizing up its competition and its strategy, trying to figure out if its stock price is fair, and, this is a big one, evaluating the team that's actually running the show. It's super thorough, but man, is it a ton of work.
But let's be real for a second. Who has time for all that? Most of us aren't professional analysts. So what's the other option? Well, that brings us to the second path. Warren Buffett has this famous saying, diversification is protection against ignorance. And it sounds a little harsh, right? But what he's really saying is, look, since most people can't be experts at picking winning stocks, the smartest move is to just own a small piece of all of them. It's the path he recommends for almost everyone, even his own family.
And the great news is, there's a really simple and powerful way to do exactly that.
And we'll call this the diversifier path. The whole idea is simple. Why spend all your time and energy trying to find that one magic needle in a haystack when you can just buy the entire haystack?
And if you want proof that this works, look no further than this. Buffett made a legendary bet that lasted 10 years. He said, I bet a simple, boring S&P 500 index fund can beat a portfolio of hedge funds picked by the so-called experts. And the results? Well, they were just jaw-dropping. It wasn't even close. The simple buy-the-haystack strategy absolutely demolished the expert needle finders.
Okay, so we've got the deep dive analyst path, and we've got the simple diversifier path. But here's the thing, you don't actually have to choose just one. In fact, for a lot of people, the best strategy is to actually blend them together.
This is where you get to be the architect of your own financial future. You don't have to go all in on just one thing. Think about it like this. You could put, say, the bulk of your money, your core, into those safe and steady index funds. That's your foundation. Then, with a smaller slice of your portfolio, you can take some shots on individual companies you really believe in. Maybe even a tiny piece for something super high risk. It's all about finding that perfect balance between safety and growth that works for you.
So, why are we even bothering with all this? What's the point? Well, it all leads to one ultimate goal: building your own money machine, a system where your money is doing the heavy lifting for you.
Yeah, exactly. This is what we call passive income. It's the complete opposite of the active income you get from a job where you're trading your time for a paycheck. The beautiful thing about passive income is that it's not tied to how many hours you can work. It can literally make you money while you're sleeping.
I like to think of your investments as a team of little workers you send out into the economy. That stock you own, it might send you a dividend check, which is just its share of the company's profits. That rental property, it sends you a rent check every single month. These are all streams of passive income flowing right back into your pocket from the assets you've built.
And this is where the real magic happens. You start what's called a wealth cycle, and it just feeds on itself. Your investments make money. You take that money and reinvest it to buy more investments. Now, those new investments start making money too. It's like a snowball rolling downhill. It just gets bigger and faster over time. This is the engine that builds real, lasting wealth.
So you see, the big takeaway here is that investing isn't really about the thrill of picking the next hot stock. It's about methodically, deliberately building a system that secures your financial future.
So I'll leave you with this question. Your money is a powerful tool. What are you going to build with it? Thanks for joining this explainer.